Hello everyone and welcome to Financial Accounting. In this video, we will discuss how the allowance for doubtful accounts is treated in preparing a cash flow statement using indirect and direct methods. Let's briefly review the indirect and direct methods. Accounting standards allow the operating section of the statement of cash flows to be prepared using either the direct or indirect methods. The statement of cash flows prepared using the indirect method adjusts net income for the changes in balance sheet accounts to calculate the cash from operating activities. The cash flow statement presented using the direct method lists all major operating cash receipts and payments during the period. Let's also review the allowance for doubtful accounts, the rules of debit and credit for this account, and how it is recorded. This will help us understand how this account is treated in preparing a cash flow statement. The allowance for doubtful accounts is management's best estimate of the amount of accounts receivable that customers will not pay. The allowance for doubtful accounts reduces the total amount of accounts receivable appearing on the company's balance sheet. It is listed as a deduction immediately below the accounts receivable line item. This deduction is classified as a contra asset account. Accounts receivable is an asset account. It is increased by debit and decreased by credit. Allowance for doubtful accounts is a contra asset account, and the rules of debit and credit for this account are the opposite. It is increased by credit and decreased by debit. When we record our estimated bad debt expense, we debit the bad debt expense account and credit the allowance for doubtful accounts. Note that cash is not involved in this transaction, but net income is decreased because bad debts expense is increased. Therefore, an adjustment is required to determine the cash flow from operating activities. Let's first look at how the allowance for doubtful accounts is treated in preparing a statement of cash flow using the indirect method. Assume Sullivan Corporation has the following balances in 2023 and 2022. The balances in the accounts receivable account were $90,000 in 2022 and $150,000 in 2023. The increase is $15,000. The allowance for doubtful accounts increased by $6,000. From $4,000 in 2022 to $10,000 in 2023. Remember that these are credit balances. The net accounts receivable increased by $9,000, from $86,000 in 2022 to $95,000 in 2023. Recall from the journal entry slide that an increase in allowance for doubtful accounts results in a charge to a bad debt expense. Since no cash was involved in that transaction, the company should add back an increase in allowance for doubtful accounts to net income to arrive at net cash flow from operating activities. Let's look at the indirect method for presenting this information in a statement of cash flows. Because bad debt expense is a non-cash charge, a company must add it back to net income to arrive at net cash flows from operating activities. Alternatively, a shortcut approach can be used. Instead of separately analyzing the allowance account, we can net the allowance balance against the accounts receivable balance and compare the change in accounts receivable on a net basis. In our example, an increase in allowance for doubtful accounts of $6,000 is netted with an increase in accounts receivable, which is a negative $15,000. This is how the statement of cash flows looks when presented under the alternative method. The increase in accounts receivable is presented net of the allowance for doubtful accounts and is a negative $9,000. Now, let's look at how the allowance for doubtful accounts is treated in preparing a statement of cash flow using the direct method. If using the direct method, a company should not net allowance for doubtful accounts against accounts receivable. We will use sales revenue instead of net income, and recording the allowance for doubtful accounts doesn't affect sales revenue. Assume that the company's sales revenue for 2023 is $100,000 and expenses are $60,000. Net income is $40,000. Note that the bad debt expense of $6,000 is listed on the income statement, but it is a non-cash item. Recall from the direct and indirect methods of reporting operating cash flows video that accrual basis revenue includes sales that didn't result in cash inflows. Cash received from customers, which is sales revenue on a cash basis, can be computed as net sales minus an increase in receivables. I am posting the link to the video here and in the description box if you want to watch the video. Now let's look at the proper presentation of the statement of cash flows under the direct method. Cash sales should be reported as $85,000, which is $100,000 sales revenue minus a $15,000 increase in accounts receivable. The bad debt expense is not included in the cash paid, as it is a non-cash expense. Let's compare the cash flow statements prepared under the indirect and direct methods. Note that regardless of the method used, the net cash provided by operating activities is the same, $31,000. I hope you found this video helpful. If you did, please subscribe, hit the like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.